One of the concepts I talk about regularly on asymmetric investing is the smiling curve. And that's because it explains a lot of what happens on the internet, why certain companies win, why other companies don't, despite maybe having a lot of users, maybe even very popular products, why niche can be very valuable. And it explains exactly what's going on in the streaming business today. And today I want to look at this in context with the recent results and the write-down from Warner Brothers Discovery. This is a company that seems like it's in a very good position from a streaming perspective. They say that they have 100 million subscribers. They have really good content with House of the Dragon, Game of Thrones. They currently have the NBA. I'll get to that in a little bit. But it seems like if you were going to start a streaming service, this would be one of the better options. But it's not winning in the market, and that's becoming a huge problem because the company's balance sheet is also extremely stretched. So what in the world does Warner Brothers Discovery do from here? What should we expect as investors? And why does this reinforce that I think Netflix and Disney are the only place to be in media today? That's what I'm going to dig into. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start by putting up just a simple explanation of the smiling curve. So this graphic shows what the smiling curve itself looks like. And you want to either be on the top right, where you have built scale, you have pricing power, you have operating leverage in your business, or you want to be on the top left, very, very low operating costs. I would be an example of somebody who's living in the top left corner of the smiling curve. There's no overhead for running my media business because it's very, very small. The problem is you don't want to be in the bottom middle of the smiling curve. You don't want to be at the point where you can't afford the best content, which ends up attracting more subscribers. You don't want to be at the point where you don't have pricing power because you don't have the best content. And then you're also in a downward spiral from a user perspective. You just don't have enough users to build any scale in the business. This is why there's a reinforcing loop on the way up in the top right, and there's a reinforcing loop or a slide down to the bottom of this smiling curve as well. So let's look at this in context with the recent earnings report. This is a high level look at what happened in the quarter. You can see the total revenue is $9.7 billion, down 5%, excluding foreign currencies compared to a year ago. So overall, the business is on the decline. Now, there are a couple of things when I compare to a company like Disney. Disney has the parks business to lean into. So they always know that they have $8 to $10 billion or so of operating income coming from that parks business. Warner Brothers Discovery doesn't have the same benefit. So they need to survive on the linear channels and then the direct to consumer business. Linear obviously declining, and direct to consumer is also not doing particularly well, at least on the bottom line. There was also a net loss of $10 billion. That includes a $9.1 billion non-cash goodwill impairment charge from the network segment. So what they are doing there is they are putting what they think the value of the networks business is on the balance sheet. When you make an acquisition, you put the value of that acquisition on the balance sheet. And a lot of times, if you're paying more than book value, what you have to do is you record goodwill. So this is a non-cash asset. But if that asset then becomes less valuable, you have to write down that goodwill and say, you know what, there's not as much value there as we thought. So that's what this is. It's a non-cash card charge, but it is acknowledging that the business is not nearly what the company thought it previously was. So why is there this non-cash charge? Softness in linear advertising market and affiliate fees, and uncertainty to relating to sports rights, including the NBA. This is the big one. Warner Brothers Discovery did not win the rights deals for the NBA beyond this next season. That was actually taken by Amazon and NBC. There's a whole backstory there. They kind of messed up the negotiations, didn't want to pay as much as the NBA wanted, but now you have less of a draw. You have less of a reason for both customers from a direct-to-consumer standpoint and also cable companies to pay you your affiliate fees. So your business is less valuable. That's why you're writing it down. Subscribers to direct-to-consumer business, 103.3 million, an increase of 3.6 million subscribers. Now I'll get to this in just a second, but there's some context that's needed because that includes more than just Max. This is not just Max. This is Max, this is HBO, this is all kinds of other streaming services. So here's a look at some of the high-level financials. You can see this loss, but again, a lot of that is a non-cash loss. But the trend that you want to look at here is adjusted EBITDA, cash provided by operating activities, and free cash flow. These are all in rapid decline. And remember, this is even before the impact of losing the NBA. Now your business is going to be even less valuable. That linear business is going to be even less valuable after you don't have the draw of the NBA. Networks, I'm not going to spend a lot of time here because you probably know what's going on with cable and the loss of subscribers overall. Distribution, this is going to be your affiliate fees, negative 9%. Advertising is going to follow that because if you have less distribution into houses, you're going to have less advertising demand. Content was actually up a little bit. Overall revenue down 8% and adjusted EBITDA fell 8% as well. The direct-to-consumer segment, this is streaming. This is supposedly the future of Warner Brothers Discovery. This is what you need to see making money. Total revenue down 6% in the quarter. Remember, this is not just Max. This is HBO, this is Max, this is Discovery Plus. They've got a couple other services that are also included in here. So this is not the same as Disney reporting over 100 million subscribers just for Disney Plus. The equivalent would be Disney adding together Disney Plus Hotstar, Hulu, and ESPN Plus. You do all of those things, you get a much, much higher number than 100 million subscribers. But that's exactly what Warner Brothers Discovery is doing here. And it kind of confuses the numbers a little bit. But you can see that distribution is about flat. Advertising was up nicely. Content down a little bit. So that's really the reason for the decline in revenue. But adjusted EBITDA, this is the number that we want to see improving. This was a negative $107 million. And again, the value of the streaming service is not going to be as high when they don't have the NBA at the start of the 2025 season. So all this leads us into, what are they going to do with the balance sheet? This is really the problem for Warner Brothers Discovery. The linear business is in decline. The streaming business is not yet making money. It's not clear how they're going to be the highest bidder for the next great piece of content, whether that's sports content, whether that's other content that is out on the open market, especially when companies like Disney and Netflix have plenty of cash to make those acquisitions. Because look at this, $3.6 billion in cash on hand. That's not a lot of cash on hand for a company the size of Warner Brothers Discovery. $41.4 billion of gross debt. That is an incredibly high amount of debt when you look at the amount of free cash flow coming to the business and the trajectory of that free cash flow. So free cash flow is on the decline, and that cash flow is what you're going to ultimately end up using to pay down the debt long term. So you combine this debt picture and the worsening cash flow for the business, and this is why Warner Bros. Discovery is sliding down to the bottom of the smiling curve. And that is fundamentally the challenge the company has right now. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So again, the reason I like the smiling curve as a way to explain what's going on in these markets is it shows exactly why Warner Brothers Discovery is doing so poorly, why they were not one of the highest bidders for the NBA deal. Look at the streaming business and their trajectory of the linear TV business. They have to really pinch pennies, whereas a company like Netflix or Disney can say, you know what, this is such a valuable strategic asset to have. We want to be one of the winners. So Disney gets kind of that A block. They get the best content, the NBA finals, things like that. Those are all going to likely move to ESPN over the top in the future. That's what's going to drive more subscriptions to their streaming service and the bundle that they're developing. So they have a much bigger user base than Warner Brothers Discovery, and they're going to be able to charge a higher price because they have better content. That's going to reinforce on itself because the next time a rights deal comes up, who's going to have more money? Well, Disney's going to have more money because they already have the most subscribers and the highest price. So they're going to be able to pay more for the next piece of content. That's going to make them an even bigger draw. And Warner Brothers Discovery is going to fall down because they're going to lose again. They're going to have B and C level content, whether it's sports or whether it's other content that they have to acquire. I think ultimately the right strategy move for Warner Brothers Discovery is just to shut down all of the direct-to-consumer business and sell the content they have to these successful streaming companies. And they may be forced into this given the balance sheet that they have right now. But that's the way that the market is likely going to play out. And it's because of the reinforcing loop that ends up happening with digital businesses. And I don't think that things are going in the right direction for Warner Brothers Discovery. The recent results, the loss of the NBA, are kind of canaries in the coal mine. And when you contrast that with Netflix doing extremely well, continuing to add subscribers, with Disney continuing to a little bit slower add subscribers, but they're raising prices and they have much more scale than a lot of these competitors like Max, like Peacock. Those are the two companies that you want to be in the streaming business, not with these companies that are losing, that are still losing money and don't have any strategic way out. So that's the way I'm looking at this company today. It's why I'm not investing in it, and I am investing in Disney. But let me know what you think about the future of Warner Brothers Discovery. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.